inflation. We also got a bump in pretty volatile month to month, but outside of that, it's very much on track. And I've been talking for a long time about how the economy is, or how inflation is cooling. It's just cooling too slowly. Well, I can say that it is now cooled to room temperature. I mean, at 2.5% year over year, there really is not a significant inflation problem. I realize that shelter is going to take a little while to come down from here, but even on things like auto insurance, 0.6%, it's at least it's coming away from a 20% year over year gain. So overall, it looks very well controlled to me. It looks like we're not seeing deflation. We're just seeing a gradual disinflation. The inflation is gradually coming out of the system. And frankly, unemployment 4.2, CPI inflation 2.5, add those together 6.7. That's better than it's been 85% of the time over the last 50 years. So it's really not a bad economy. It's a good economy. And I don't think it calls for any drastic Fed action. I'd be very happy to see 25 basis points next week.
So we're in the quiet period. We've got all the data now. Given what you just said, David, does this reinforce the case that we get 25? I know you'd be happy to see it, but do you expect it?
Yes, I do, because I think the Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do. It is settling into a softer expansion, a slower expansion. That's what they want. So they only have to gradually return to normal in interest rates.
This, to me, is a really interesting moment. David Kelly and Steve Risciuto, I think, are going to agree. Steve Risciuto is here. And is this something that you kind of agree on, that 25 basis points is the appropriate and logical conclusion from this data we just got?
Yeah, 25 has been our call for quite some time. We haven't changed it. We didn't fall into the overall concept of 75 basis points or 50 basis points. This rate cut arms race that my colleagues on the street have been engaging in, I think, has been counterproductive. I do think the reality of the situation is one where, yeah, it is a healthy economy. And that really goes against the point of, well, then I really can't get into the inflation numbers and throw this and that out and say it's really going nowhere or it's room temperature. And taking out the household component of this, the rental component of this, I also think is wrong, because when you look at the dynamics of the rental market, we were all worried about the excess build of residential real estate, and guess what? It's all being used up. So I don't think rents are going to be something that comes down. And I think it's indicative of the fact that the economy is fundamentally healthy. And a 4.2% unemployment rate is low. And therefore, it is a healthy economy. So the Fed should be moving people's expectations back from these large rate cut discussions into a much more gradual, steady approach at getting back to neutral, and really begin the debate over what is neutral, because their number of 2 3/4 is much too low.
Yeah, no one really wanted to engage with that in any kind of verbal way. In Jackson Hole, I am curious if you're surprised by the market's reaction right now that equities are lower, at least initially, understanding it's not always the correct move or the one that's going to stick. But does it make sense to you that it would be lower by taking 50 basis points, maybe a little off the table?
Yeah, because if I have a possibility of the Fed overstimulating, I'm going to have a bit more inflation. And if I have a bit more inflation, guess what? I'm going to have better earnings. I'm going to have a stronger economy and better earnings. So I think, as Jonathan was talking earlier, I think what the market is really doing is saying, okay, we have a really good economy. We know we can get this level of earnings. If they're going to really push this thing with 50 basis point cuts, as a lot of people want to anticipate, we're going to have an economy that is going to potentially accelerate in 2025. And I could potentially think about raising my 2025 earnings numbers, not cutting them.
Steve,
from 15%.
When you talk, you sound that rosy. The economy is doing very well. Do you think there even should be a rate cut?
Look, you've reached, excuse me, you've reached a point in the cycle where inflation has come down to a level that you could begin the process of normalizing rates. The real question is, where is that level of neutral rates? And this is the debate, to me, that really matters, because I think the neutral rate is 4%. A 2% real return, a 2% inflation target, assuming they can get there, 4% Fed funds rate. The Fed is thinking 2 3/4. The market is thinking 2.5 to 3. So they're basically in the 2 3/4 category. That's much too low. And if we get to that subsidy level of interest rates, then you wind up pushing the economy. And I think this is where the Fed is not doing its job. The Fed really wants to believe that we're going back to that post-financial crisis, pre-COVID period of exceptionally low levels of interest rates. And I just don't see us getting there, because that was a unique period in time where we had what? We had a debt overhang, we had a bank restructuring, and we had a massive tax increase.
Steve,
That's
you're
not
echoing
happening.
something that we heard from Torsten Slok. He was basically indicating the same thing. He was asking the question as to whether we are actually sufficiently restrictive. David Kelly, I know you've got thoughts on this matter, so let's discuss it with you as well. Where's neutral? How are you thinking about neutral?
Yeah, I know Steve and I are supposed to disagree, but I think we're quite close in this one. I would say 3.5% to 4%. I mean, if you look at the 50 years before the great financial crisis, the federal funds rate averaged 2 percentage points above core CPI inflation. If we end up at 2% on inflation, I have no problem with the federal funds rate at about 4%. But I do think that, and I think the Fed's long-term target will probably gradually go up. It certainly should. But I also think they should gradually move rates back down to that level, because I think we are suffering today from the aftermath of interest rates which were way too low between the great financial crisis and the pandemic, and that caused an enormous inflation in home prices and other asset prices. You know, the carrying cost of crazy was zero, and so we've got a lot of crazy bets out there. Now, I think a lot of Americans are locked out of the housing market right now because home prices are too high given a normal level of mortgage rate. So I want them to, you know, if there's nothing wrong with the economy fundamentally, if it's basically on the right track, you shouldn't have an active policy either way. You shouldn't be restrictive. You shouldn't be stimulative. You should get back to neutral. And neutral is less than, 5.25% to 5.5% of the federal funds rate. So they should get going, but they should go slowly, because there's no need to upset anybody here. Just gradually get back to neutral.
Bond market's still falling. Yields up now by almost 10 basis points at the front end of the curve. On the 10-year, up by 4 basis points. And that 2-year, 10-year, just turning negative. Just briefly, we'll see if that sticks for the 5th time on this programme. Stephen Schutt, I want to come back to you. You touched on it, the differences between now and 2019. The difference between where you think neutral is and where the Fed is, anywhere between 100 and 150 basis points. Why are they still there in the twos? Is it because they don't want to have the conversation yet? They don't want to signal where things are? They haven't thought about it? Or do they truly believe this is where neutral is?
No, again, I think the policymakers that you're looking at are political economists. And getting back to that low level of interest rates allows them to do things that they would like to do. It allows them to try to create an environment where they're going to try to rebalance income distribution, and they're going to try to grow the employment rate and grow wage and salary income to make up for the shortfall that was created by the COVID inflation. And I think this is their underlying motivation. I can't argue with the motivation. I can argue with the tactic to get there. I don't think the aggressive adjustments or the fact that we have to get to lower levels of rates are going to do it for them. I think they're better off doing, again, David and I agree, doing a very gradual approach to allow the economy to adjust to this, allow the economy to move on its own basis, not based on policy stimulus. This is a Fed that I think wants to add policy stimulus in 2025 when there's going to be less fiscal policy stimulus. And then when we get a new president, we get a new budget, we're going to have fiscal stimulus in 2026. So they're going to try to juice the economy as long as they can because they believe global deflation bails them out.
I'm not sure if I should be happy or nervous that you both finally agree, but this is what we've got.
Scared.
David Kelly, Stephen Schutt, to the both of you, thank you guys, appreciate it. Inflation coming in just a little bit hotter than expected. Lisa, at the front end of the curve, we're seeing a sell-off in bonds and a bit of a pullback in equities as well off the back of this.
You know, it's interesting. You were talking about that 10 basis point move in yields, and that sounds like a lot, but based on recent moves, it hasn't been that much. I wonder if this is a new normal, right? That without some sort of guide from the Fed, without some clarity, if this is the kind of move that we're going to see on an ongoing basis.
Are you expecting to see some notes that now say 25 instead of 50?
Pretty much across the board. That's what the market's saying. If you look at world interest rate projections right now, there is about 29 basis points of a cut being priced in. Basically, it's 25 basis points that's being priced into the market now.
Certainly feels like that's the base case as this market prices out the more aggressive tone at the front end of the curve that we've seen build up over the last month. We're up by 9 basis points on a 2-year to, let's call it, about 360, 370. We pause now for a moment of silence, being held throughout the city of New York and across this country and around the world in remembrance of the September 11th terror attacks. At this time, 23 years ago, hijacked American Airlines Flight 11 struck the North Tower of the World Trade Center.
Right, march.
Is the Vivian Tom clientele?
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Healthcare giant Johnson & Johnson is staking its future on innovation. Making investment decisions under pressure has become business as usual for CFO Joe Wolk.
The world is coming at us faster than it ever has. We're getting information more quickly. We're going to have to move faster. The competition's moving faster.
Watch Chief Future Officer Wednesday, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Minutes away from the opening bound, pulling back by 1/3 on the S&P 500. A little bit more on the small caps this morning with a sell-off in the bond market. The 10-year is looking at a yield that's higher by 4 basis points. The 2 years down and yields are up by 8. In foreign exchange, the dollar is now stronger. Dollar yen had dropped to 140.71 earlier in the session. It's now back at 142.40. We had some economic data about 20 minutes ago. CPI coming in hotter than expected, 0.3% month over month, excluding food and energy. So that's the core print. We were looking for 0.2. That very marginal difference, apparently the difference between the Fed going 25 instead of 50 a week from today. We'll have that conversation in just a moment. As we count you down to the opening bell, a couple of things to watch for the markets in the next couple of days. Here's your trading diary, the calendar, the agenda. Tomorrow we'll get an ECB rate decision, US PPI data plus another round of jobless claims. And on Friday, UMich Consumer Sentiment Report comes out as well. And Mike McKee's with us around the table still, our economics and policy correspondent. Mike, that was the last CPI print going into the Fed decision a week today. There is a feeling that this shifts away from 50 and shifts the conversation towards 25.
It wasn't definitive, so it didn't make a real case for 50 basis points. But I want to go back to what we were talking about earlier with the impact of housing on this. And if you take housing out, how inflation has really come down. You look at the 12-month rates, and we talked about that, 2.5% for the headline, 3.2% for the core. That includes inflation a year ago, which is not relevant to the Fed anymore. You take a look at the 6-month moving average, and it's 2% for the headline and 1.8% for the core. And then if you look at the 3-month, the most recent 3 months moving average, 1.1% for headline CPI and 2.4% for core. So inflation has really dropped. And if you look at those numbers and think about how PCE translates, 3, 4, 5 basis points lower, the Fed is in a good position to cut. If they felt there was a need, they could point to those numbers and say, we could do 50.
Right now, the market is saying they won't. Right now, the market is saying they're going to go 25 basis points because that way they can go gradually and kind of not spook anyone. Is there any data between now and a week from now that could change this picture? University of Michigan sentiment survey, anything that really could potentially tip the difference?
I don't think so. There hasn't been any indication. We saw the New York Fed numbers on inflation expectations. They didn't move really. The Michigan expectations numbers, even if they move, wouldn't move all that much. So I don't think that would be the only possible thing that could derail it if people suddenly said inflation was coming back. But with these kind of numbers, you don't think that's the impression that people are going to get, because food prices, as we said, leveled out. Gasoline prices went down.
So, Mike, are you calling it? It is no longer debate. It's 25?
Oh, I did that on Jobs Day. But yeah, I think 25 basis points, because that's the Fed's kind of base case. They're risk averse. They are in the process of managing risk, and they would rather do 25 and see what happens rather than do 50 and then have some sort of surprise where they'd have to backtrack. So I think at this point it is likely to be 25 unless there's something we don't know about, which of course gets to that argument of what do they know that we don't know.
Of course, not much. There were 2 Chairman Powells in the summer. One Chairman Powell suggested the labour market was strong and that's a reason to wait, a reason that we can be patient. Then Chairman Powell in Jackson Hole, Wyoming sounded like a 50 basis point rate cut chairman. Which chairman do we hear from next week after that inflation report?
I think you'll hear more of the 25 basis point chairman, but one who expresses confidence that inflation is now going to get to their target, and so they therefore can continue moving. And then you look at what Chris Waller said about if we see further data showing the weakening of the economy, we could front load, we could go to 50. So that'll be on the table for a while till we see all the data ahead of the November meeting.
We hear a little bit more from the man from Sintra and not the man from Jackson. Is that fair?
Probably. What I'd like to see is actually dissent. What I'd like to see are some of the people who are calling for 50 basis points and saying just to make things accommodative right now. Austin Goolsbee, for example. Austin, I'm looking at you. Chicago Fed president. If you dissent, I think that would be a valid way to sort of represent that people do have different views in the FOMC committee. Just suggestion.
Who are the voting members you're looking for that might dissent next week?
I think the only one that would be a possibility would be Mickey Bowman. She's been fairly firm on that, but the problem is she's a Fed governor, and we haven't had a governor dissent since 2005. So it would be seen as a big deal, so she would have to really feel like it was important to make that case.
19 years. Sure. Yeah. 19 years since a governor dissented on the FOMC.
But this is the issue. They clearly disagree with one another. What's the problem, right? Why not just represent the views in something other than commentary, just to highlight, look, we're not sure, so, don't read too much into this. We're just humans.
This bond market keeps selling off. Yields are higher by 7 basis points. The equity market a little bit softer. Lisa, as you look at things going into the opening bell, what jumps off the page for you?
I want to see equity response to the idea that the Fed isn't going to necessarily cut by 50 basis points. That, to me, absolutely the most interesting.
How constrained is that so-called Fed put?
Yeah.
I think that's a big question for us all over the next week. Coming up tomorrow, Sharon Bell of Goldman Sachs will catch up with Mohammed Al-Aaron of Queen's College, Cambridge, Mike Schumacher of Wells Fargo, Lindsay Piegza of Stifel. From New York City this morning on September 11th, as we often say, time may pass, we will never forget.
The top names at Jackson Hole are on Bloomberg.
So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that, sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
If I were at the Fed, I would be thinking about the tools that we have in the toolkit differently. I would be utilizing quantitative tightening, and to a great extent, they have. Post-COVID, $12 trillion came into the global economy from central banks everywhere. And right now, we've seen about $5 trillion has been hoovered back out. That still leaves $7 trillion sloshing around in the system globally relative to where we were before COVID. Now, adjusting that for larger GDP growth globally, probably we need to see about $3 trillion more come out before we get to an equilibrium of where we were before COVID. I don't think the Fed really appreciates the quantitative tightening tool as much as I do, and I think as much as the markets do.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We've got about 30 minutes until the start of trading. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Of course, two of the biggest stories in markets this morning are last night's presidential debate and this morning's CPI print. Markets clearly responding to the latter right now. You look at pricing with about 30 minutes to go until the opening bell. The S&P 500 down about 0.2%. The NASDAQ 100 back to unchanged, of course, in the futures market. Interestingly, you take a look at the 10-year yield, up a little bit, 3 basis points. The real action is in the 2-year Treasury yield, of course, up about 6 basis points to 7 basis points right now as traders really trim back their bets on a 50 basis point rate cut. Right now, we're priced for about 29 basis points of easing at next week's Fed meeting. On August 5th, we were pricing in 49 basis points of Fed cuts. So clearly a bit of a rethink going on in this morning's trade.
Yeah, the 2-year, of course, going to be most sensitive to any change in expectations for rate cuts. We've got a fantastic lineup of guests to talk us through the inflation data as well as the presidential debate last night. We're going to kick it off with former Bridgewater chief strategist Rebecca Patterson. Omer Sharif of Inflation Insights is going to join us to give us his take, and Henrietta Treyz of Veda Partners joins us, as well as CEO Howard Lutnick, very close to the tragedy of 9/11, as well as the presidential election right now, because he will be Donald Trump's, if Trump wins, he'll be the co-head of his transition team.
And it's really interesting. He's actually with Trump and J.D. Vance this morning down in Lower Manhattan. But to that end, you have to wonder what is going to drive the narrative now. Many people thought the presidential debate was really what would set the stage, but you had that CPI surprise, and it really comes down to shelter costs. We know this is a politicized issue in this environment.
Right.
There are still at least 50 basis points of rate cuts priced in to later this year after the election for both sets of meetings.
Well, shelter costs, of course, rising by 0.5%. That was a big surprise. Of course, Constance Hunter on Bloomberg Radio highlighting that that's a problem for the Fed. What's interesting, though, is this move in core. You have to wonder how much this really factors into what the Fed feels like right now, because the room temperature of inflation is coming down, but clearly this report showing that it's not completely extinguished.
Yeah, I guess I hadn't really thought of it as a big surprise myself, since it's only 0.3%.
You've got to go out on the decimal
How much control
exactly.
do they have over housing at the end of the day?
Yeah, we'll get into all of that, the nitty-gritty of the inflation numbers, as well as how the Fed could or should react to that on September 18th. But, of course, we're going to be talking about the debate front and center. Also, it is September 11th. Today marks the 23rd anniversary of the 9/11 terror attacks that hit New York City and Pennsylvania, as well as Washington, D.C. in 2001. We honor the victims, first responders, and all of those around the world impacted on that very day with a moment of silence in observance when United Flight 175 struck the South Tower of the World Trade Center.
And my great and my grandfather, FDNY Captain James J. Corgan. We love you so much and we miss you so much. Me and my 3 sisters wish we got to meet you.
Gary Eugene Bird.
Joshua David Birnbaum.
George John Bishop.
Chris Romeo Bishundat.
Jeffrey Donald Bittner.
Albert Balela Blackman Jr.
Christopher Joseph Blackwell.
Carrie Rosetta Blackburn.
Susan Leigh Blair.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Bloomberg loves loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at where markets are trading. Less than 30 minutes to go until the bells ring. You can see a bit of a recovery underway in the pre-market. The S&P 500 before the bell rings currently flat on the day. We had been lower. Same story, too, if you look at the NASDAQ 100. A more dramatic move there. Of course, big tech going from negative on the day to up about 0.2% as markets work through, of course, that CPI data that we got at 8:30 Eastern, showing a little bit of a surprise to the upside on core inflation, but still looks like we're shrugging it off, at least in the equity market. The bond market, an interesting story as well. The 10-year yield of about 3 basis points, but the 2-year yield, where you should really be focusing your attention, Matt, currently up about 6-7 basis points.
All right, for more on that inflation data, we're joined by Michael McKee, Bloomberg's chief international economics and policy correspondent. So, Mike, a little bit of a jump. I guess it could be looked at as a big surprise to the upside on the month-over-month core number, but everything else is bang in line and inflation looks pretty tame.
It does, and it is. At this point, the numbers that pushed inflation higher on a core basis come from housing, as you mentioned, up 0.5% during the month, and from airfares, which were up 3.9% during the month. Kind of volatile figures, and the Fed, of course, can't really affect the housing in numbers at all. So as you can see, we are still on the inexorable path down towards 2%, and that's on an annual basis, which includes inflation a year ago that nobody cares about right now. On a 3-month basis, we're at 1.1% and on the headline and 2.4% on the core. So the trend is clearly lower and lower and lower. And as you mentioned, we are seeing a change on Wall Street in their thinking about what the Fed's going to do. We are now down to a 25 basis point cut. 29 basis points is the futures priced in. And so we're not looking at this point like 50 basis points is expected by anybody anymore after this CPI report. One other thing I want to mention, because you talked about, Katie, at the top of the show, the two important things this morning were the CPI and last night's debate. Last night's debate, there was talk of food prices. Food prices completely flat during the month. There was also talk of bacon prices. Bacon prices were down big. And, of course, if you need to replace, say, your pets, pet prices are down.
There you go. Pet prices are down.
Why would you need to replace your pets?
That's the thing. There's not a lot of turnover in those numbers, I imagine.
Unless someone's been eating them, right?
He was definitely waiting to say that for hours this morning. Anyways, Michael McKee, we thank you so very much for your analysis. We now have Rebecca Patterson, former Bridgewater Associates chief investment strategist, joining us now. A little less on the pet prices, a little more on kind of the undertone there. There's politics and policy, and then there's the actual numbers we see in the data here. If we kind of sit here today and kind of incrementally rewrite the narrative into the end of the year, what's going to matter going into that Fed meeting and into the election?
So I think the inflation today at the margin is tilting investors towards 25 basis points in September. And then the question is, do we get 25, 50, the final 2 meetings of the year? It will depend on the data. I know that's a horrible answer, but it's true. I think the bigger deal is going to be next year. I think there's 2 big question marks around the market pricing for Fed funds next year, which is still, even after the CPI, we're looking at total between now and the end of next year, about 250 basis points of rate cuts next year priced into the market. So one question is the election. If former President Trump were to win a second term, I think the market is perceiving that that would be relatively more inflationary. That could slow the Fed down with rate cuts. So that's an important factor. He would probably need a sweep for that to be truly impactful. But even without a sweep, he could push forward on trade policy, on immigration policy.
Yeah, it does look like the most inflationary aspects of his plan are the ones that he could push through himself.
Correct. Correct, without Congress.
Yeah.
But then the second factor that I don't think is getting enough attention is the transmission of monetary policy. How smoothly does it flow through to the economy? And with so many mortgages, 60% of mortgages locked in below 4%, and with so many corporations, especially larger corporations, with long-term fixed low borrowing costs, it might take quite a bit of easing to start see that support, if you will, come through to the consumer and the business sector.
Well, there's a lot to dig into there. Of course, when you think about the politics, who knows what's going to happen? Of course, the polling going into this was 50-50. It's going to be interesting to see how that shakes out. But you make the point in your notes that the Fed can't anticipate what's going to happen. They have to react to the data that we have on the ground. So you think about the numbers that we got at 8:30. You think about, you go through, of course, what we learned with shelter.